Well, cooler than expected inflation data out of the US led the markets to say that the Fed is done last week, with swaps now pricing no chance of any further tightening, while seeing almost 100 basis points worth of cuts being delivered in 2024. That pretty chunky dovish repricing sent the dollar into its worst slump since the middle of July, as treasuries rallied pretty hard once more, led by the front end of the curve, and equities notched a third straight weekly gain. It's a holiday shortened week this week, with the US observing Thanksgiving on Thursday and markets partially closed on Friday as well. But there's still a fair bit of data to dig into before that. And of course, we also have the autumn statement in the mix here in the UK as well. Plenty to discuss on the trade-off this week. Without further ado, let's get into the show. So it might only be a 3-day week for the financial markets this week, but I think it's going to be a fairly busy 3 days before everyone puts their feet up and the US go off for their Thanksgiving celebrations and their turkey, of course, on Thursday. Joining me, as always, on the trade-off this week, Ryan Littlestone from Forex Flow Live and Forex Analytics. Ryan, a very good morning to you. How are you doing today?
Yeah, hi, Michael. I'm doing fine, thank you very much. Touch of the lurgy last week, so just recovering from that. But yeah, a 3-day week would suit me well this week.
I think after the month we've had, I mean, it sounds ridiculous to say we're already at the end of November, but after the month we've had, I think a 3-day week is going to serve us all pretty well, I would imagine. But plenty to get into, despite the fact that it is a short week. So let's roll into Topical Thunder right away. So there's only really one place to start this week, and that is with some of the US data that we had coming in last week. The CPI report, which was last Tuesday, it feels like a lifetime ago, significantly, well, not significantly, it undershot expectations. The reaction in the market would have you believe that it was a significant undershoot, but actually it was just a percentage point below, a tenth of a percentage point below expectations. Headline CPI rising 3.2% on the year in October, core coming in at 4% on the year. So still clearly above where the Fed would want inflation to be at 2%, but nonetheless showing that disinflationary process continues in the US economy. But along with that, we had some cooler than expected PPI data, producer prices coming in at 1.3% on the year in October. And we also had some further data showing that the labour market is softening, continuing jobless claims rising to 1.86 million in the week to the 4th of November. That's almost a 2-year high. And what that shows is that not only are people losing their jobs, but it's also taking longer for people who lose their jobs to then get back into employment. So when you put all of that together, you've got a picture of disinflation continuing, the labour market softening at probably a more rapid pace than we have been expecting. And while it does continue to show signs of a soft landing for the US economy, the unequivocal message from the financial markets last week is that the Fed are done and the hiking cycle is now over, with the IS curve pricing out any chance of further tightening and now fully pricing the first 25 basis point rate cut for June next year, with 3 further cuts priced for the remainder of 2024 beyond that. So, as I said in the show intro, a big rally in treasuries, 20 odd basis points lower in yields from 2 to 10 years across the curve, a big headwind for the dollar. We've moved back to the middle of the dollar smile now. I don't think we're in this US outperformance, US exceptionalism regime. We seem to be moving back towards one where the US is sort of catching down, if you'll excuse the cliche, to the rest of the world, and that posing a pretty chunky headwind for the dollar index having its worst week since July and trading in early trade this Monday morning below the 104 handle. And I think, Ryan, the big difficulty now for the FOMC is they need to communicate the inevitable in the December meeting, that the tightening cycle is done. I think the market's expectations of that were clearly cemented last week. But they're going to have to do that while, again, trying to ram home this higher for longer message, because 3.2% on the headline CPI number, yes, it's clearly moving in the right direction, but the job is far from done, isn't it?
No, that's the thing. And that's going to be the message, I think, that they're going to have to put in place at the next meeting. We're not done in terms of fighting inflation. We're not there yet. There's more to be done. And I think that it's that old balancing act again, isn't it? The market knows, everyone knows that probably we're done with hikes. But how do you keep the message in there without letting the market get too dovish, especially when it's going to start potentially to see weaker data like we're seeing from those continued claims numbers? Still yet to see a lot of the other data rolling over. I was looking through it. We saw, some of the housing numbers last week doing okay. One went down, the NHAB, that dropped significantly, but then housing starts and permits beat expectations, were up on the prior month as well. So it's give with one hand, take with the other at the moment, and that's the balancing act they've got. Everyone can see signs of weakness, but also signs of strength. So the message they give, I think they've got to give that same message. Powell's got to keep that hawkish tone in, that they're not done yet. They're prepared to do more. There's potentially a surprise in inflation still into the end of the year, and that the fight's not over. They've got to keep the rhetoric in, or the market, as we know, will take the extreme dovish side.
Absolutely. It's a very delicate balancing act. And as we often see in the economic cycle, the market probably overprices the tightening cycle and then probably overprices the loosening cycle as well. And of course, as you're going to go on to, it's not just in the US where we see this happening.
No, and we're going to talk about rate cuts again. Obviously, we're in full tilt dove at the moment, as we mentioned, or as you mentioned in the opening. The Fed pricing already 100 pips of cuts, because if central banks aren't hiking anymore, the market knows there's only one way rates are going to go from here. The cut pricing is worth updating on that subject right now, just to see where we are, see how the market's laying. Previously for something like the Bank of England, the market was pricing two lots of cuts, 225 pip hikes in 2024, one of those for August, one of those for November. Now we're also pricing 100 basis points of cuts in the whole of next year. We even have Goldies expecting the BOE to maybe start cutting from February. There's a big hike up from February, I think it was.
Sorry, I haven't seen that note, as you can see.
I think it's one of their, they probably think it's more June, July, but there is a possibility of February stuck in there as well. The ECB, same thing as well. We were pricing around 50 pips of cuts probably the last time we spoke about this. That's in at 100 BPs now as well. Most of those calls are for the ECB to start a little later than the Bank of England, pushing it out to maybe July, sometime like that, before we start the first cuts. And as we said, in the US, they're still looking over their tea leaves, analysing their tea leaves for expectations are pretty wide over there. Yes, we've got that broad 100 basis points of cuts. But if you look at the CME Fed Watch, they'll confirm where that's shown. But then you have UBS, they're on the uber dovish side. They see some 270 pips of cuts next year and a terminal rate of 1.25% by early 2025. That's just getting the hatchet to everything. Others are a bit more measured, see less cuts and those cuts coming later. But it differs amongst the banks. So there's a lot of uncertainty amongst the so-called big players as to what the Fed's going to do. But irrespective of all the guessing, what is clear is that we're right in the thick of the rate cut play, pretty much as we've been predicting since late summer. And this very moment is now about how extreme those call gets. UBS is the sort of marker to watch for that. But if the market fully takes that line and starts to aggressively price cuts to that level, and if they do that before the DEC FOMC, I feel that's the potential time to look for a counter trade, because the Fed aren't going to cave that easily into the end of the year and probably early next year, and there'll be a ton of fight left in them to keep the higher for longer message in play. And the same goes for the other central banks too.
Yeah, absolutely. I was actually discussing this very point with our esteemed friend, Mr. Weston, when I was on my way into the office this morning. You've got to think that central bankers have probably been a little bit scarred by the whole transitory experience back in 2021, when everyone was saying inflationary pressures are going to be temporary, we can look through it in the data, etc., etc. So when you're now looking at when are they going to cut rates, they're also probably going to want to perhaps overreact a little bit rather than underreact and keep policy more restrictive for longer, just to avoid any risk that inflation does make a resurgence and and then they effectively make the same mistake twice and lose even more of their credibility. Just a couple of other points I would make. I've just gone and actually dug out that Goldman note. You are absolutely correct. They've just to embellish what you were saying, they've put a 15% probability that the BOE will cut within the first quarter of next year. I think that hinges on there being a full recession within the UK, but nonetheless, the possibility of that happening is there. But I think what's important to recognise is, as we said, the market is likely to overreact in terms of pricing in cuts. But central banks cutting rates next year is, yes, they're easing policy, but we're still going to remain at or as close to or just above the neutral rate. Nobody is talking, apart from the folks at UBS. I'd love to know what they're drinking and ideally have some of it. But apart from them, no one is talking about going back to zero interest rates or even negative interest rates. What we're talking about is actually going back to where rates, quote unquote, should be, and keeping real rates positive, because, of course, as inflation fades, real rates will actually start to tick higher if the central bank leaves the overnight rate at its current level. So relatively, the policy stance probably won't change too much next year. But I could talk about that all day. You know that, mate. Yeah,
well, you're right about the inflation worry, and we've seen it from the Bank of Canada. We've seen it from the RBA. They actually hiked because of what they see as inflation not coming down as fast as they want it to. The US CPI, I think one of the reasons we got such a big reaction on the fact that it beat expectations or missed expectations, whichever way you want to look at it, came in lower than expectations, was that the last 2 months we'd seen inflation rising. So the Fed also have been in the grip of, okay, we've had inflation coming down. It's now bounced for the last 2 months. And this was a bit of double relief. Yes, it fell back as expected, but it did a bit more on top too. So the market breathed a huge sigh of relief that perhaps hikes weren't coming back on the table. And I think that's why we got that bigger reaction. But you're right, they are scared of it, and they'd rather overdo and undo the damage later than underperform like they did when the inflation was rearing its ugly head.
Yeah, absolutely. Right. Well, that's enough about monetary policy. It's going to be a busy week of fiscal policy as well, particularly here in the UK. I can tell you're looking forward to it, Ryan.
I saw this one. Yeah, I've got my cup of tea. Go on, you crack on, mate. I'm going to put my feet up while you get through this one.
Is it tea or is it lemsip? What are you on these days? Anyway, it is a busy week. It is a busy week here in the UK this week. It was a busy week last week. It's going to be an interesting one on the macro front this week as well. Some of the data that we had last week, I guess it was a mixed bag when you look at it on the whole. We had some good news on inflation, CPI coming down to 4.6% on an annual basis in October. So still a long way above the BOE's target. A lot of that being driven by the base effects of a fall in energy prices. But nonetheless, it is good news. We shouldn't be too harsh on Mr. Bailey and co at this point. We had a bit more mixed news on I know you're shocked that I'm being nice to him for once. We had a bit of mixed news on the labour market. Unemployment holding steady at 4.2%. Of course, the caveats around how the ONS are calculating that data still apply. Earnings still growing as near as makes no difference, 8%, which is far too high and incompatible with a return to the 2% inflation target, of course. And then it was just downright bad news in terms of consumer spending. Retail sales falling a third of 1% on the month in October, and that's after a fall in September as well. And of course, the ONS giving our favourite excuse, which was that we had bad weather in October, which is why retail sales fell. I mean, how many times are they going to roll that one out? In any case, the focus this week does turn to the fiscal side of the equation. Chancellor Jeremy Hunt will be delivering the autumn statement after Prime Minister's questions on Wednesday, so around about 12:30. Hopefully, this will not be as exciting as the fiscal event that we had last autumn, which, of course, caused a bit of a meltdown in the gilt market and sent cable to record lows. The focus is going to be on how the Chancellor uses this fiscal headroom that has magically appeared. It's somewhere between 10 and 25 billion, according to most estimates. So forgive the rather horrific spread that I'm offering you there. What's interesting is that this headroom has not come about because of anything the UK economy has done. It has come about because the OBR's economic forecasts were so terrible that they have now been revised to actually show we've got more money and more space to meet those fiscal rules than we previously expected. There's a lot of speculation going into the autumn budget, the autumn statement, forgive me, as always. A lot of speculation that we may see some tweaks to income tax, maybe even national insurance. There's also going to be something called full expensing brought in terms of corporation tax, which is a glorified way of saying people can get rebates on their tax if they invest in capital goods and machinery and things like that. I think the sort of fiscal big bang, if you like, is going to be saved until March. That's when we get the next budget. That will be about 6 months out from the next election. So that is when we're likely to get some more significant measures. And of course, the ruling Conservatives try and win some votes with those measures. I think any fiscal loosening is probably going to improve the UK economic outlook at the margin, but I don't see it being a huge event for sterling, although I don't want to say that because we are all still somewhat scarred by the events of about 14 months ago.
Yes, indeed. This one is going to be purely a election play in all its bells and whistles. The Conservatives are on the ropes, been on the ropes for a couple of years now. They've blown one of the biggest majorities they've ever had, a government's ever had. So really, this is all about how much they can wheedle out of the electorate before next year's election. So I expect, like you say, they've found this mystical headroom or the money tree at the bottom of the garden suddenly sprouted up late autumn, and now they've got money to spend. So amazing that. But for the market, I don't think it's going to be much. Things to look out for, really, like you say, anything on corporate taxes, anything that eases the burden there, that's going to be good potentially for stocks and firms who have a lot of dealings in the UK as well. So it could be something to watch for the FTSE. Anything lasting? No, like you say, if there's anything that looks growth indicative in tax cuts, we're going to have to wait to see if it's borne out down the line. It's not going to happen straight away. I think likely there's very little volatility for this, but expect a lot of election-sounding niceties to come, and then we'll look underneath, or the press 10 minutes afterwards, we'll look at the details underneath and see where he's given with one hand, what he's taken with the other.
Yes, of course, because political journalists are the best people to work out a fiscal announcement in the 10 minutes after it, aren't they? Anyway, before I get in trouble, we best talk about some of the other events that we've got going on this week.
We're into the busy 2-month holiday period, particularly for shopping. That kicks off, obviously, this weekend with US Thanksgiving and all the infamous Black Friday and Cyber Monday sales events. Now, in the old days when Michael was still playing with his My Little Pony toys and I had hair, these funky events didn't exist.
I had hair as well.
Yeah, exactly. Yeah, I wonder where yours went. But anyway, these sales events didn't really exist. So it was just December that was the holiday shopping period, particularly in the UK. In fact, I remember in my old time, some of my Christmas shopping period was usually a mad dash to Woolworths on Christmas Eve to buy the family gifts, whilst hungover from whatever city parties I've been to that week.
At least it wasn't the petrol station, mate.
I could tell you another story about my mate doing his Christmas Day in 7-Eleven, but that's for a different story. So, you've been there, I'm sure. But nowadays we have to take... Nowadays, we have to take both November and December sort of as an average to define whether it's been a good holiday period for retail sales. So we have to wait probably till January to get a fair idea of how things have gone. But things have changed even more now with technology. So I wanted to give everyone a bit of a heads up for some much faster data that can come. Usually the big event sellers like Amazon, issue preliminary sales estimates a day or two after they've totted up the numbers. But Adobe Analytics have been a bit quicker now. They now release even faster data, which can be a bit broader than the single retailer numbers. Their reports are usually just for online sales, which in the US still only account for around 15% of total sales. So not a big slice, but it's significant nonetheless. So for all you stock traders out there particularly, there's some potential volatility to get your teeth into next Friday and across into next week. When those Adobe numbers drop, because they'll give you an idea of how the Amazons are doing. And as for us fundamentalists, we'll be watching those to see if retails are showing a strong consumer or not, across the US and other economies too.
Yeah, absolutely. I was very comprehensive there, mate. I don't have too much to add to that, to be honest with you. I mean, we obviously saw the fragilities coming through in terms of UK consumer spending last week in that retail sales data. So it'd be interesting to see if that, well, not only if it picks up here as we move into the festive season, of course, but also if that is starting to come through in some of the other developed market economies. And of course, a big week in the US with Thanksgiving as well. But yeah, it is interesting the number of sort of higher frequency data sources that are starting to come through. I remember during the pandemic, that was obviously something we were watching very closely. We were looking at, traffic data, people tapping in on the tube, all that kind of thing. So yeah, it may not be immediately market moving, but it's just pieces that come out 2, 3, 4 weeks in advance of the official stats that help, as you say, build that broader macro picture that can give you a bit of an edge when the time comes for that data to be released.
Yeah. And a bit more anecdotal evidence. I think I mentioned it last week about how I was out in Southampton the prior weekend, and it's absolutely ramo. I was out again this weekend, just at my local estate, shops like Dunelm, the Range and all that sort of thing. Again, absolutely, heaving, the Christmas aisles, shelves were empty of Christmas lights and stuff. Maybe this is just the early sales periods, people are getting out and stocking up, but I think November in the UK, I'm going to call it, I think we're going to see higher retailer numbers, and they may be quite good as well.
Well, there we go. That's the kiss of death on the UK consumer for the rest of the year. Right, before Ryan jinxes anything else, let's get on to some charts. It's normally me that jinxes things around here, so I'm just relishing the possibility that someone else may have put a curse on an economy somewhere. In any case, let's have a look at some charts. I want to look at the Aussie and the Kiwi first of all, and this is a bit of an interesting one because I actually put all of this together yesterday and then had to redo it this morning because we saw, for once, a fairly lively Asia session, and actually the Aussie dollar has now broken above this 65 handle, and the Kiwi dollar has also broken above the 60 handle. But as you can see on the chart, and as is always the case with these things, it's where the market closes that is key, not necessarily what happens on an intraday basis. It's 8:30 in the morning. This could easily be another failed break. But there is quite a lot working in favour of the Antipodean currencies at the moment. We've got risk assets rallying pretty nicely. As I said earlier in the show, last week was a third straight weekly gain for the S&P 500. The dollar is rolling over in a pretty significant manner. The dollar index below 104 and trading at its lowest since the start of September. And you've also got the market's perception of geopolitical risk continuing to diminish. Crude on the verge of entering a bear market last week, and also gold only really rallying because yields came lower. So I think the only thing that's really holding the Aussie and the Kiwi back at the moment, and those big figures 65 and 60 respectively, had been almost like a brick wall for some time now, for 3 or 4 months. I think the main thing that's been holding both back is continued worries about China. We had some activity data out of China last week, pretty much bang in line with expectations, not exactly incredible or stellar by any means, but there's still plenty of stimulus coming out there. And I think this is just something worth keeping on the radar. We don't go down under too often on this show, but I think if these big figure levels do break and do hold on a closing basis, they could be pretty significant. Positioning is relatively neutral in both, and given how long the ranges have held, that old adage of, the longer a range holds, the more impactful and the more sizable an eventual breakout tends to be, may well hold true again.
Yeah, I think you've nailed it on the head there. I hit the nail on the head. Yes, they have seemed a bit laggard. It has been a bit of a surprise. Obviously, heavily commodity related as well. So you're right. China, a few people still thinking that they're over the worst of it. They may be. I still don't think they're out the woods yet, as you mentioned with the data, as we mentioned with the data as well. So, yeah, I think there's a bit of a drag going on there. The broader commodity space as well. Oil's, 1 minute it's collapsing, next minute it's having a little bounce, and vice versa. But it's still not, moving significantly higher. So there is a bit of weight around a lot of commodity currencies' neck at the moment. But as we've seen with the euro, which you're going to talk about shortly, if you do start getting those moves, if you do start getting the trend breaking, then it can pick up steam. So I think you're right with your levels. If you start to get closes above that red line there, that's your cue to maybe get on the bandwagon if you haven't got in at lower levels.
Absolutely. I know we're going to talk about the euro. I'm already coming out in a rash. Anyway, before we do that, what about Treasury? Something that we're all much happier to talk about. Yeah,
exactly. And the Treasury yields, or yields in general, I'm going to look at to measure those dovish extremes we were talking about earlier. So I wanted to look at yields as a sort of follow-up to my rate cut segment. I said there would be three stages to the situation. First, trade in the market starting to get into rate cuts, which we've already seen. Second, trade in the market getting uber dovish about those cuts, which, again, we've already started to see. And thirdly, trading what actually happens with cuts. So now I think we're sort of still in the first phase, coming into the second phase, and using the front end yields as a guide for that market extremism is what I'm going to be doing. I think for now, 100 basis points of cuts predicted is probably about right for next year, whether it's the Fed, BOE or ECB. The evidence thus far suggests that economic weakness in those countries, but no one's falling off any cliffs, so there shouldn't be any panic to ease by those central banks. But it's what the market thinks that will bring the move. So front-end yields will give a good indication of whether the real market is buying all the dovish calls and repricing for a certain amount of cuts. So to use one example, looking at the one-year yields will give us clarity on the real market levels. Looking at the US one-year yields, we're still in trading, right around the current Fed funds rate. 2 years are some 40 pips off the FFR, but nothing significant compared to some of these calls we're seeing from the banks. So really, we're not pricing much in cuts here. Excuse me. If we see something like the one-year yield, dropping to, say, sub 4% very quickly, then we know we're probably getting into market overreaction levels. And that might be the moment to look at potentially fading a trade, particularly if that's coming into the next FOMC. Now, I should add a bit of a caveat. I'm using these yields in their most simplest forms. Of course, there are things affecting US yields outside of just interest rates, like all these auctions. And there are also other instruments people can use, like the rate markets for SOFRs for the average trader. It's easier to look at something like these yields. You can have them on most charts, just pop them up. You should always be watching yields anyway. But having these handy just to have a glance now and again to keep things simple, just to see if you're getting any of these excessively dovish moves coming into the real market, that will give you your line into a potential trade, a potential fade trade, if you like.
Yeah, absolutely. I think treasuries are in a very interesting spot here, not just at the front end, but also if you start to look longer, further out along the curve. The 10 years trading just shy of 4.5%. And obviously, when we were up at 5.1, it was the risk reward tilted heavily in favor of being long at that point and buying bonds, lower yields, of course. Now I think that's a little bit more evenly balanced. And I do think some of those other concerns are starting to come back into the market. You mentioned supply very briefly. Obviously, we had that rather poor 30-year auction. Was it last week or the week before? I think it was the week before last, where we had that brief spike in 30-year yields. We've got a 20-year auction a little bit later on today. So we will see on Monday, by the way, it will have happened by the time you're watching this. So we will see how the market reacts to that, of course. But if you're trading financial markets, any market, and you're not watching treasuries with at least a passing interest, then I'm going to say it again, you are doing it wrong.
Well, there you go, everybody. You've been told off. They know what to do.
There you go. Slap on the wrist. Right. I'm also talking about yields, and I also promise that this is not just an excuse for me to get a chance the S&P 500 in another way, because I'm sure those accusations are going to be levied at me. Look, he's already off. But what I think is interesting is we're looking at cable here, and we're just comparing how cable has been trading to two of its key drivers. On the top, you've got the spread between 10-year gilts and 10-year Treasury yields, and on the bottom, you've got effectively how cable is trading in relation to risk. And I've just used the S&P 500 as a bit of a lazy proxy here. And the reason I've done this is because we've seen sterling continue to rally, despite the fact that the fundamentals of the UK economy continue to look pretty soggy and pretty weak, as we saw with that data that we mentioned earlier in the show. And what's interesting is we actually see a little bit of a divergence between what I would argue are the two main drivers of the pound at this point, which is something that really we haven't seen for probably a year or 18 months, judging by these charts, because sterling is continuing to track the spread between 10-year gilts and 10-year treasuries pretty closely. But actually, we've seen sterling become a little bit detached from the typical relationship and the typical correlation that it's displayed with the S&P 500, where a very, very crude overlay suggests we should be 3 or 4 big figures higher than we currently are. Now, I am not going to sit here and say sterling should be trading at 130. That is not what these charts are saying. What I would argue more is it just gives a little bit more insight into actually some of the drivers that are behind the moves that we're seeing. And actually, if we were to see, for example, a pullback in risk, how that could affect cable, or if we were to see the yield spread widen again, how that could affect the pound. And of course, we've got a fair bit of event risk here in the UK this week. We've got the autumn statement that we mentioned. We've got flash PMIs on Thursday. And we've also got half the MPC testifying in front of the Treasury Select Committee, including the Governor, Andrew Bailey. That's on Tuesday morning. So I continue to favour selling into cable rallies at this point, particularly around the 125 handle. But if you look hard enough, there might be a bull case out there somewhere.
Yeah, it's a bit tough for the quid at the moment. Again, you know, that's why it's important to look at the crosses as well to see what's happening there. And if you look at euro sterling, it's pretty steady. It's looking a bit more stronger than it has of late in favour of the euro. But through all this, the last couple of days, it stayed there or thereabouts, you know, 87, 30s, 50s, that sort of area. Cable, obviously, that's at the mercy of what's going on in the dollar. As we know, it can always run a bit faster sometimes than euro dollar, so that's something you've got to keep an eye on. I think it's a bit dangerous looking at selling rallies right now. If you do so, you've got to be quick about it. You know, if you get some profit on the table on a short, you know, you've got to be looking to book a lot of it and tighten up your stops at least, because you are fighting a pretty strong trend. As I say, this is a dollar move. More than a pound move, and you're right, for the sake of the pound, you wouldn't be buying it. What's going on in the UK and the data this week and for the next couple of weeks is going to potentially be decisive for whether the UK is going to be hit by all these rate hikes a bit harder than elsewhere. So I'm keeping an eye on that very closely. But yeah, for now, the trend is your friend, particularly with something like cable, I think.
Indeed. Well, what about dollar yen? Because obviously the rally in treasuries, I think it's the Fed are hating it, but it's music to the Ministry of Finance's ears, I would imagine.
Yeah, well, maybe this could be the time that we actually see a real drop, and when dollar yen really starts to find some real sellers. Well, I've heard this morning already that apparently PIMCO have been in selling it since it moved into the 140s. Apparently, they've been just selling dollar yen FX. I haven't heard that they've been doing anything else. I don't know what they've been doing on the carry, because they've been paying it away for a couple of months. If that's the case,
deep pockets, presumably.
Well, they've got to have deep pockets. They need to have a real significant drop to start getting their money back on that. But anyway, they're the ones with the pockets. They can do what they like. But meanwhile, dips have been pretty fleeting in this pair. But for some recent data volatility and continued fraying nerves about intervention, have seen it quick to fall, but just as quick to recover. Now that's changed a little bit, because what we've done, we matched that October 2022 high up near the 152 level last week, failed to break it thereafter. We've also stepped down resistance from that high on a prior test up to sort of 151.40s. This current move from 149, I'm getting all my numbers tied up to this morning, I'll tell you. The move from the 151.90s found support at that 150 level, which was important on the break up. But after that move to 151.40, the next move broke below 150. We're back below 150 now. It's actually been resistance. So that's significant for this break. This morning, we've had a move down to the 148.60s. Had a bounce into 149s. As we sit here now, it's trading 148.70 again. So it's getting a bit jumpy out there. 150 is your main resistance level now. So there's going to be a bit of noise in between, I think. If we get another confirmation at 150, then we're potentially heading for a sustained, significant push lower. The green light for a real clear out will be if we go down to break the 147 level. That's marked a bit of a range between 147 and 150 over the last few months. So that's my big watch area for the downside 147. If we get down there and hold it, that might just say we've blown off a little bit of steam off the top and now we're going to range again. But if that goes, then PIMCO might actually start to be making some profit there. But as you can see from the chart, we don't really start making a dent in the 2023 trend until we get to testing the 38.2 fib. And that's still, 600 odd pips away. So a long way to go before we really look like we might be testing the overall trend. It may be a bit early to call for a big move lower, but given the mood in the dollar right now and with the market thinking a bit more hawkishly about the BOJ, the stars could be finally aligning.
Yeah, time will tell. We all said 2023 was going to be the year of the yen, so God knows, maybe 2024 or 2025. We'll be right eventually.
Yeah, but it's how you trade it. The problem is you couldn't get in shorts and sit on them because it would cost you because it never gave you a dip, any reasonable dips in all that trend bar a couple. And if you're sitting in shorts, you're just paying money away. So 2-3 weeks sitting on that at something like 4% interest, it's going to cost you a lot of money.
Yes, you're exactly right. And I think that's something to pay a very, very close attention to as we do move into next year. You are going to see that policy divergence narrow from both sides. The BOJ should be tightening things up. The FOMC are likely to be cutting and easing. So the lower cost of carry may entice a few more bears back to the table as well. Right, let's get on to our plays of the day. Right, now I'm going to be a bit of a hypocrite this week. I threatened to evict Ryan from the show last week for being long the euro, so I guess I'm going to have to now evict myself from my own show once I've delivered this call to you. So I'll be leaving and Ryan can wrap things up. But I am looking at the euro dollar this week, and actually even for me, it is very, very hard to argue with the bull case from a purely technical point of view. I'm going to have to hold my nose and go against my better instincts and go with the trend at this point, because the chart, for me, it is really one that speaks for itself. The common currency having a very strong week last week, closing above the 100 and the 200-day moving averages for the first time since August. We're also now comfortably made a closing break of the 50% retracement of the decline that we saw in the third quarter. And we've also made a closing break and in early trade this Monday morning, extended further above the 109 figure. So this is a rarity for me in that it is purely a technical trade, given that even though the US economy does seem to be showing signs of slowing, it is clearly still outperforming that of the Eurozone. But I am going cautiously long the euro this week with a relatively tight stop just below that 109 figure. Initially looking to take a bit of profit at 109.70, which is the 61.8 retracement of that Q3 decline, and then maybe the 110 handle as a final upside target. So right, I'm off to go and wash my mouth out with soapy water. Ryan, you can deliver your play of the day.
Yes, well, I'm going to get right back at you, and I hope you're not giving my euro longs the kiss of death with that call getting in final at the top. Then I've been long since 115, and I'm liking this move. So I hope you haven't just torpedoed that. But no, good luck with your trade. I think going with the trend is the way to play it. And if we see 110, I'll be getting off some of mine long as well. So don't worry about that. You let me know when yours is, and I'm going to stick mine in 5 pips below anyway. I'm going to my play of the day this week is gold. It's been a rinse and repeat of my play of the day from a couple of weeks ago that unfortunately didn't trigger. That was the short up into the 2009 area, those prior highs, for the exact type of move we saw then, a dip down to the support zone around the 38.2 fib in the 1930s. So I'm looking for a similar play. Just because it might have worked last time doesn't mean it will work again this time. I'll be watching the price action very carefully for this one. If we see a sort of grinding move up to that area, spend a bit of time hitting our head on the 2000 level, while not really dipping back, and the dips, absent or very shallow, I'll be a bit more cautious. If it's a similar sort of price action to dollar yen, where it just keeps moving up, I'll be a bit more cautious that there's a bit of strength behind that buying and that a break might be imminent and we break through. Then in that situation, I'll probably won't get into this trade. But if we have a bit of a quicker move there, more short-term move there, I'll give a shorter go up into that area 2000, 2009, but I'll keep it as tight as I would have the last trade. Stop around 2012, 13, nothing huge, and see if we mark another top upper there.
Good stuff. Thank you, mate. Well, that does bring us to the end of another show. Thank you very much, as always, to Ryan Littlestone from Forex Slow Live and Forex Analytics for joining us. And also thank you to Kyriakos, our producer, for bringing this together as brilliantly as he always does. If you enjoyed the show, drop a like on the video, leave a comment as well. Let us know how you're trading the markets, or if there's anything you want us to have a look at this time next week. And that is exactly when we will be back with another episode of The Trade Off. Thank you very much, as always, for watching, and we will see you then. Goodbye for now.